and welcome to this video on relevant costs and decision making. This is the first video in the P2 tuition video series, and it serves as a very good introduction to P2 as a whole. A lot of the concepts that we're going to look at today will serve you throughout the rest of the video series. And as the title would suggest, what we're going to look at today is relevant costs, what they are, and the various decisions that they allow us to make, various decisions that we as management accountants would make within our various different organizations, such as the minimum price we can sell our products for, whether we produce our own raw materials or we purchase them and bring them into the organization, what we should produce if there are various limiting factors, if there is a joint costing process where certain products, several products are made off the same production line, how do we allocate costs fairly to each particular product, before looking back at P1, looking at marginal costing, marginal pricing, and how relevant costs affects that. There's more of the financial side to it, before finally looking at the various intangible and non-financial factors that relevant costs mean for us, that decision making means for us. And it's worth noting that intangible factors, non-financial factors will become more and more prevalent now that you are on management level, and particularly when you get to strategic level. We're moving on from just the numbers, so to speak. So let's look at relevant costs. What are they? I'll start by looking at, or by giving you a very simple example, something you can perhaps relate to. So imagine you're going on holiday, you're planning on going somewhere nice where it's sunny, etc. So what do you need to look at with regards to costs? Well, of course, you need to look at the cost of the flights, you need to look at the cost of the hotel, cost of the villa, etc., the cost of the food that you're going to consume, the drink that you're going to consume while you're there. But what you don't consider, or what you shouldn't be considering, is things that you already have, such as clothes, such as your phone, iPad, books, technology, all these sorts of things that you already have that you are going to take with you. Why? Because of course you've already paid for them. You shouldn't factor in the fact that you've spent all this money on clothes and phones and books as a relevant cost when it comes to deciding on where you should go on holiday. So in short, we do look at the costs that are directly involved with the holiday. We don't look at the costs that are not directly involved. So how does this relate to businesses and to investments? Well, we'll look at that now. So investment decisions are affected by the costs involved. So let's look at some examples of the kinds of costs that will be involved when we are deciding whether an investment should go ahead, whether a project should go ahead, etc. So the cost of the product that we are selling. How much does it cost to make? Because of course that will affect how much we charge for it. The cost of the staff that will be involved. Will we be using existing staff at the business who of course are not a relevant cost because they are already working for the business, or will we need to employ more personnel? The cost of the raw materials involved. Is it material that we already have? Do we have storerooms full of all the different raw materials needed to make this product already purchased, or will we need to bring in new materials? The cost of assets. Do our machines currently have the capabilities, have the capacity to make these new products? If not, we might need to bring in new machines. That, of course, will be a relevant cost. And finally, the cost of resources as a whole. Will we need to buy new planning software in order to effectively manage the creation of this new product? And other things like that. This is more of a miscellaneous one. In short, all the different costs, all the different things that might be relevant to this new project. So, what are relevant costs? Let's look at the different types of relevant costs now. So, in short, relevant costs are future cash and incremental costs relevant to the project. As you can see here, summarized, directly arising as a result of an investment decision. So only the costs that will be directly occurred as a result of going ahead with this investment decision. So let's look at a couple of examples to show you what I mean. So, example number one, we're going to buy a new car. We have car A that costs $4,000 but costs $1,000 per year for the next 3 years. And we have car B that costs $5,000. So the initial cost of car A is far lower, but the total cost is higher because, of course, $1,000 a year for the next 3 years, that's $3,000 plus the $4,000 for the initial cost, giving us $7,000 in total for car A, $2,000 more than car B costs. However, our current car can be sold for $3,000. Now, is this a relevant cost? Does it factor into our decision making? No, because we get the funds for selling the current car regardless of which car we choose. We wouldn't even need to choose car A or car B. We could still sell our current car for $3,000. It does not factor in to our decision making between car A and car B. So, another example now. A property company has already spent $110 million on a project. However, they need another $100 million in order to complete it. And after they've completed it, they can only sell it for £150 million. Now, should they complete it? Should they invest another $100 million, bring it up to $210 million just to make $150 million? Or should they cut their losses and move on? That's the question we need to answer. And of course, some of you may be looking at that and thinking that no, they shouldn't. They should just think that it's gone, the opportunity is wasted, we'll write this off and we'll put more research into other projects in the future. But of course, using relevant costs, we know that they should complete it because that $110 million is a sunk cost. We're not spending $210 million to make $150 million. We're spending $100 million to make $150 million. Because that $110 million, just like the current car in the previous example, we have already spent that money. That cost is not relevant with regards to making this $150 million. And so some of you, I'm sure, have noted that there is a difference between relevant costing and general financial accounting costs. Because, of course, financial accounting requires we show all our costs. So that $110 million would show up, and therefore it would perhaps look like a poor investment decision. $210 million invested to make $150 million back. Whereas relevant costing ignores costs such as that initial $110 million, which shows perhaps a better, brighter picture of the investment decision than it really cost us, because according to relevant costing, it showed that we'd only spent $100 million. But of course, financial accounting is not always optimum for decision making, because looking at financial accounting costs, you would perhaps look at that $210 million and say that's too much to spend to make $150 million. It's a huge loss. But of course, it is not factoring in the fact that we had spent that $110 million. That $110 million would be written off with zero return if we didn't invest that additional $100 million. So now let's look at the different types of relevant costs, the different types you need to be aware of for when you are sitting your exam. Now, the first one we have is future cash flows. Now, this can be revenue, this can be costs, this can be construction, this could be anything that is relevant to the project. Purchasing it, maintaining it, resale value, costs incurred, revenue you'll get from it, or so on. If it will only be incurred, be it a cost or a revenue, if you take on board the new project, then it is a relevant cost. Incremental costs, much in the same vein, these are additional things that you'll need to bring onto the organization in order to fulfill this project. For example, employees that are already there at your organization, drawing a salary, drawing a wage, will not be a relevant cost to this project. Additional employees you need to bring on to ensure it's a success will be. Opportunity costs, I've given the symbol here of a bottle to symbolize a glass half full, etc. Essentially, this is the value that you lose by taking on this project. So going back to employees, even if they're employees that are already at your organization, therefore they're not an incremental cost, but if you have to take those employees off of a different production line and put them onto your new production line, then the opportunity cost is the value that you've lost from their work on the pre-existing production line. Depreciation and amortization. Now, this is out and out an irrelevant cost. It is not factored into the equation at all here because, of course, we're only looking for cash flows, things that are going to either cost us more or things that are going to bring money in. Now, depreciation and amortization are not costs. They're not associated with anything to do with new projects because depreciation and amortization are accounting adjustments. They only exist insofar as we create them in our actual balance sheets and statements of financial position. Committed costs. Committed costs are costs that have not yet been incurred by the organization, but they will be incurred no matter what we do. Classic example is leasing. Let's say we're going to lease a new factory for 2 years. Now, if we've already committed to pay for that and it's not dependent on this project, it's nothing to do with this project, it is still a relevant cost, or in a sense it's an irrelevant cost but relevant to our decision because we are going to have to pay for it anyway. So it doesn't make any difference to us, it doesn't make any difference to the profitability of this new project whether or not we go ahead with it based on this committed cost. Allocated costs. Allocating costs as well, very similar to committed costs. But where the difference lies is that whereas committed costs are usually committed externally, allocated costs are committed internally. So, for example, let's say a bank. Now, banks obviously have to keep up with relevant government legislation, they have to keep up with training, client training, etc. And so, costs that we have allocated to training, costs that we have allocated to improving the business to comply with legislation is going to happen regardless of taking on a new project, going ahead with something different, and therefore it cannot play on our minds, it cannot be a reason to take or not take a new opportunity. Avoidable costs. These are in a sense costs that will, as the name suggests, be avoided by going ahead with the project. So these are a relevant cost. So let's say we're going to go ahead with a project where we have to purchase all kinds of new materials in order to fulfill the project. Now, if we don't go ahead with that, we'll save all that money. Those costs won't be incurred by the business. In a sense, this is almost the opposite of opportunity cost, whereas opportunity cost is the costs that we incur as a result of taking resources off of something else and putting onto the new project. Avoidable costs are the costs that we save by not taking on the new project. And finally, sunk costs. Sunk costs we've discussed already. Essentially, it's money that has just already been spent, and regardless of what happens next, that money will not be salvaged in any way. So, for example, let's say we're buying a house, or we're deciding whether or not to buy a house, and we've had the mortgage company conduct a survey on the house to see what they think of it, see what it is worth. Now, regardless of whether we actually go ahead and purchase this house or not, we won't be able to claim back any of that money for the survey. So it should not play on our mind. It shouldn't play on our mind as in, well, we can't afford that house price because we already spent this much on the survey, or be ashamed not to go ahead with it now because we already spent all that on the survey. No, we're not going to get that money back regardless of whether we go ahead or not. It is gone. The money is gone and should not affect our decision. So that's relevant costs. Now let's look at the kinds of decisions that relevant costs allow us to make, starting with minimum pricing. Now, Minimum pricing relates to relevant costing because relevant costs should be then calculated together, and the total sum of all our relevant costs should be the minimum price. Minimum price equals the sum of relevant costs, as I've summarized for you here. And the selling price of any product should not be lower than this minimum price, because of course if the minimum price is the sum of all relevant costs and we sell for cheaper than the minimum price, then we would be losing money on every product we sold, which of course is not what we want to do. So going back to our building example now, the relevant costs were 100 million. So the minimum price should also be 100 million, and anything less than this and we should abandon the project. But of course we could sell it for 150 million, sorry, and therefore we should have gone ahead with the project because we were selling it for a total that was larger than the sum of our relevant costs. So let's throw in a curve ball now. We could sell that half-developed land, the one that we've already spent 110 million on, for 60 million pounds. Now, of course, you'll remember, looking at those costs that we were looking at in the previous section, that this 60 million now becomes relevant because it is an opportunity. If we go ahead and spend the extra 100 million to complete the project, to sell it for 150 million, we are passing up the opportunity to sell it for 60 million. So this becomes a relevant cost now. So we add our 100 million that we already have in relevant costs to that 60 million as an opportunity cost that gives us 160 million. This now becomes our minimum price. So all of a sudden that 150 million is not the best thing to do because it is less than the sum of our relevant costs. So their only option would be to push the finished project buyer up beyond 160 million. Otherwise it would actually be better to sell that half-developed project for 60 million. Now, obviously, just caveating minimal pricing in the real world, it's unlikely that the minimum price would ever be the actual price because, of course, it doesn't factor in other costs, the more financial accounting costs, for example, or the fixed costs that we have. It doesn't factor in the margins that we want to make, the profit that we need to pay back to our shareholders, etc. But nevertheless, it does serve as a good yardstick for the price range that we should be looking at. Because, of course, just because it's the minimum price doesn't mean that's the actual price. It just means this is the absolute minimum that we can possibly sell it for. So now another decision that companies often have to make is to produce or to purchase. So we're going to look at financial considerations and also the non-financial consideration when it comes to producing or purchasing. Starting with one you're more familiar with, which is financial consideration. So, Company D makes cars and they need 10,000 engines to put in these cars that they produce. Now, let's take a look at what it costs them to produce these engines themselves internally. So, per unit, the material costs £200. The labour involved costs £100. And applied variable costs to the production of these engines is £100, giving us a grand total, as I'm sure you've guessed it, £400 per unit. And of course, when we scale that up to the 10,000 engines, we get 4 million in costs. Now, they can purchase these engines for £420 per unit. But that, of course, would mean they'd be paying £20 more per unit. The total cost would be £200,000 higher. So, on that basis, surely it seems better to produce them. However, what if the time spent producing these engines is time that certain employees, certain resources can't be spent elsewhere? And as a result, a certain other product or other activity that they do cannot be done, which would have added a contribution to the organisation of £50. Now, of course, we know that this is an opportunity cost, and opportunity costs are you guessed it, relevant costs, and therefore need to be factored back into the equation. So now let's look at the per unit costs to both produce and to purchase when we factor the contribution in. So the purchase price is of course £420, but we know our material costs, our labour costs and applied variable costs come to £400. As you can see, I've just reiterated them there, but now of course we have to add our opportunity cost of £50, which gives us total relevant costs of only £420 for purchasing, but £450 for producing, meaning that it now costs us £30 more per unit to produce them internally. So that's a good example again of how using these relevant costs can help come to decision, or help us come to effective decision, help with our decision making. So now on to non-financial considerations. So of course the strategic importance. Now what I mean by strategic importance is how imperative it is to the organization as a whole, to its competitive advantage, etc. Now if making its engines itself was key to the quality of its cars, perhaps it made better engines that it could get elsewhere, and that was one of the selling factors of the car, of the company's cars, then it would be important to the organization to make its own engines. The quality as well, perhaps they're just as good in terms of the amount of power, the weight, etc., but the engines that it buys from its suppliers are more likely to break than the ones it produces itself. Then of course that has to be considered as well. Can we put a price on the reliability of the cars that we produce, given that this may affect whether or not our consumers continue to buy our cars for us. And now on to limiting factors. So essentially it's a limit to the amount of production that we can do in a period. So in a particular stretch of time we can only produce a certain amount of things. We may only have certain resources available, and therefore we cannot produce everything we want to produce. So what limiting factor analysis is all about is deciding the optimum use of resources. This is best explained using an example. So in this example we're just going to use a single limiting factor, and let's say we can only access 2,000 tons of material X and 2,000 tons of material Y. And now let's look at the various different needs we have for our different products. So we produce product A, product B and product C. And you can see here we have the quantity required for X and the quantity required for Y. We also have our sales demand and our contribution per unit, which of course will be relevant in our equation. So product A requires 1 ton of X. Product B requires 2 tons and C 3 tons. And for material Y, A requires 6 tons, B 5 tons and C 4 tons. And we know that as an absolute maximum we can sell 150 units of A in this period, 100 units of B and 200 units of C. And the contribution per unit, so how much it goes towards paying off our fixed costs, so in sense how easily we can make a profit or how quickly it helps us make a profit, is £75 per unit for A, 100 for B and 60 for C. So first thing we need to do is check the sufficiency of X and Y. So for product A, B and C, we have 150 in sales demand for A. We use 1 ton of material X per unit, meaning that to create all 150 that we can possibly sell would use up 150 tons of material X. However, it uses 6 tons of material Y per unit, meaning that overall if we were to make all 150, we'd use 900 tons of material Y. Do the same thing for B. We can sell a maximum of 100. It uses 2 tons of material X, giving us 200 tons of material X overall. 5 tons of material Y per unit, giving us a grand total or grand requirement for material Y for product B of 500 tons. And finally, we do the same for product C. We know that we can sell 200, uses 3 tons of material X per unit, so that's 600 overall. 4 tons of material Y, giving its total material Y usage of 800 tons. When we look at the totals for material X and material Y usage, we can see that we need 950 tons of material X and 2,200 tons of material Y. Now, of course, you'll realize that we can't possibly make all of these products because we only have 2,000 tons of each. So we have a surplus, admittedly, of material X, but we do not have enough of material Y. So, how do we decide which products we make? We look at the contribution per unit. So we know, when we look at our 3 different products, we have a contribution per unit for A of 75. We know that it requires 6 tons of material Y per unit. For product B, we have a contribution per unit of £100, and we use 5 tons of material Y per unit. And for C, £60 contribution per unit, and it uses 4 tons. So now we need to work out the contribution per ton, which we easily do by dividing the quantity required by the contribution per unit. Now for A, that gives us £12.50. For B, that gives us £20. And for C, that gives us £15. So we now have a contribution per ton. We can now rank and score our products. So we now need to allocate material Y. And of course, B has the highest contribution per ton, so we need to make as much of that first before moving on. Of course, when we move on to the second highest, which is C, at a contribution per ton of £15. And finally, A. So the recommended production is 100 of product B, because it has the highest contribution per ton, which uses 500 tons. And then for C, we recommend making all 200, giving us a total usage of material Y of 800. And then for A, we look at what is left. If you deduct the 500 and the 800 from 2,000, we have 700 tons left, and it uses 6 tons per unit for product A. So we make as much as we can of product A from what is left, giving us 116. Which will use all those 700 tons and bring us to our total usage. So, as you can see here, what we've done is we have looked at our limited resources, and we have, by using relevant costs such as the contribution per unit, the contribution per ton, etc., we have now decided how much of each one we're going to make based on those relevant costs, and we've maximized our output, we've maximized our revenue, our contribution based on the limited resources we have available. So now we move on to joint costing. And joint costing is essentially using 2 products, or when you have 2 products or more, with the same resources at the same stage of production. And what we use joint costing for is to accurately apportion those costs. So if we are making several products from the same production line, we need to accurately apportion the cost to each one, rather than just dividing them evenly, particularly if they are not evenly divisible. So this allows us to identify which products are not contributing, and thus we can stop producing them. And the split off point is another thing we need to bear in mind when we talk about joint costing. This is where the joint production process ends. So Let's use an example of an oil refinery. Now, an oil refinery processes crude oil. Crude oil, of course, comes out of the ground, out of the sea, etc., or the seabed. And when you refine crude oil, you create fuel oil, you create diesel, you create kerosene, and you create petrol. Now, this is a great example because all four of these products have their own purpose, have their own value, yet they're all created by the exact same process, that is oil refining of crude oil. So now let's look at what a joint costing process looks like. So let's say we have four processes. Process 1, product A and B is being created out of the same system. Moves on to process 2, and product both A and B are still on that same system, that same process. However, process 3 is the split off point. This is where the joint production ends. And then process 4 becomes a separate and individual process for both product A and product B. So, relating it back to our example of crude oil now, we need to allocate our joint costs. And there are different ways in which this can be done. This can be done via the relative sales value, which essentially means you charge costs based on how much you can sell things for. So, of course, we're talking about crude oil, we're talking about cars, we're talking about oil, petrol, diesel, etc. So if, for example, we could sell our petrol for £1 per litre, but we could only sell our diesel for 90 pence per litre, then we would apportion a slightly higher charge to petrol because it would make more money. We would charge 10% less to diesel than we did to petrol because the sales value of petrol was higher. The other one is the net realizable value. So this is slightly different. This is the net value. This is where you take away the costs. So again, using the example of petrol and diesel, petrol being sold for £1 and diesel being sold for 90 pence. If we took off the costs, and let's say we had costs of 10 pence for diesel and costs of 20 pence for petrol, then they would both have a net realizable value of 80 pence and therefore could be apportioned costs evenly. Physical quantity, this is where you allocate costs based on the amount of each particular product is created by that joint process. So, for example, in oil refining, about 47% of the output is petrol, 20% is diesel, and 8% is kerosene. So, of course, to split costs evenly would be unfair then. Why should kerosene absorb 1/4 of the costs when it's only 8% of the output? And this is what allocation based on physical quantities is about. Kerosene makes up 8%, and therefore it gets charged 8% of the total costs. And losses, of course, can be incurred during the joint costing process, and so these, of course, need to be factored in as well. And what we do is we use this formula here. So the output cost per unit is the input cost minus the scrap value of the loss divided by the input unit minus unit lost. And what this means is that the amount of petrol, the amount of diesel, the amount of kerosene we may have lost through evaporation during the process needs to be accounted for as well. So, let's look at all of this in an example. So we have a company, they make two products, product V and product W. Both are made using the same process and both are sold at the end of the process. So actually the process 3 on the diagram above is the end point, and they can both be sold after this. However, we can bring on an additional process 4, again to relate back to the diagram above, where they can be improved and thus sold for a higher price. But they can be sold without doing this. So let's look at some figures involved. So we're going to look at the volume. So material required is 10,000 units, giving us a total of 10,000 units, because of course labour and overheads aren't relevant here. The units lost are 1,000 units, so of course going back to that losses calculation, the output per cost, etc. is relevant. And we create 4,000 units of product V out of the process and 5,000 units of product W. So now let's look at the value. So the value of the material, the 10,000 units of material, is £60,000. Labour costs are 40,000. Overheads are 30,000. There's a total cost of 130,000. And these costs are allocated as such: 50,000 to product V and 80,000 to product W. So now let's look at the selling price after the common process, the selling price after the post-production process, and the variable cost per unit for post-production. So of course additional costs will also need to be incurred if we do in fact improve them post-production. So for product V, the selling price after the common process is £15, the post-production selling price is £18, and the cost involved in the post-production process comes to £2.50. For product W, the selling price after the standard process is £20, the post-production price is £22, and the variable costs involved in the post-production process comes to £3. So this now allows us to answer a question: is post-production worthwhile? Now, for product V, the net realizable value, so you remember the net realizable value is the net value after additional costs have been taken away from additional revenue or additional income. So net realizable value here would be calculated by taking that selling price, the post-production selling price, and deducting the post-production variable cost. So £18 minus £2.50 comes to £15.50. Now if we deduct that from the selling price after the standard process, that comes to 50p. So it is worth it. It's worth more to the company post-production process, or post the post-production process, than it is post the common process. But can the same be said for product W? Well, the net realizable value here is the £22, that's the selling price post-production, minus the variable costs, giving us £19. Now, of course, it sells for £20 after the common process, giving us negative £1 once we deducted that common price from the post-production realizable value. So it's not worth it for product W. But if we look at whether we should just have it as standard, and by this I mean should it be factored in, should it be built into the production process as a whole, rather than picking and choosing which particular products or even which units within each particular product are taken for post-production. So, goods sold at the end of the joint process. We need to calculate the total value of goods sold at the end of the joint process first, and then we can factor that, or we can equate that against goods sold at the end of the post-production process. So, product V and product W. Looking at our costs now, we've got 4,000 product Vs and 5,000 product Ws. And now they can be sold for £15 at the end and £20 respectively at the end of the common process. So that's 4,000 times £15 giving us 60,000, and 5,000 times £20 giving us 100,000. And the common costs, of course, are £130,000. And if we add those together, we add that 60,000 from product V, we add that 100,000 from product W, and then we deduct that 130,000 in cost, we get 30,000 profit overall. So now we need to look at goods at the end of the production process, product V and product W, of course. Now this time they can be sold for £18 per product V and £22 per product W at the end of the process. So we have 4,000 units times by £18 is 72,000. And 5,000 units times by £22 giving us 110,000. So the actual revenue is a lot higher. Rather than 160, it's now 182,000. But of course, we only have the common costs. Well, sorry, we don't only have the common costs. We have to add in the additional variable costs. So that's 4,000 units times by £2.50 for product V, and that's 5,000 units times by £3 for product W, giving us total variable costs involved here of 25,000, which means that once we deduct our common costs of 130,000 and our variable costs of 25,000 from that new revenue of 182,000, we get a profit of £27,000. Which of course is £3,000 less than for the original if we just sold everything at the end of the joint process. So one could analyze that and think that we can't just assume that we can always make the post-production process, or that we can always not do it. We need to do it for product V but not for product W. And that's an example of how we've used these relevant costs to make a decision. We were unsure whether we should just only have the standard process or whether we should do everything on the post-production process. Now we know we should for half of them and we shouldn't for the other half. So now let's look at how relevant costs tie in with marginal costing and pricing. I'm sure you'll remember from your P1 studies, marginal costing is all about calculating the amount of products would need to be produced to cover all variable costs. And it does this by valuing inventory only at the variable cost, of course, to create your contribution. And this works out well with relevant costing because, of course, it is usually the relevant cost. Relevant cost is all those various different factors, the things that are directly relevant to the particular product you're producing, the particular project you're involved with, etc. It excludes all those other things like fixed costs. And that's why relevant costing is very useful with short-term decision making, because it relates back to marginal costing rather than absorption costing, which of course you will have learned earlier in your P1 studies, which is more about your total cost, your more accounting costs. Because fixed production costs are excluded, so the problem with this is that it can often give a false picture about how profitable a particular project is. Because of course, fixed costs do still have to be paid. They are still relevant to the organization. The organization will still have to pay them. They're still relevant to the particular production department, etc. But because they are not specifically and directly applicable to this exact thing that you are doing, this exact project, etc., they're often considered irrelevant. If you remember back earlier in the video, we spoke about committed costs, we spoke about allocated costs, sunk costs. These are the kind of things that would come under fixed costs, which of course we would exclude in this short-term decision making, but they are still relevant to the organization. This is perhaps best explained using an example. So I'll give you the example now of a company that makes toy planes. They make around 200,000 toy planes a year. And they've got some costs. They've got $500,000 in director and management fee. They've got $1 million in rent per year on the factory. Now, of course, these two will be accumulated anyway, so they are not relevant costs. They are not variable costs. But they do have a variable cost per unit, which is £10. And of course, if they're going to make 200,000 units, their total variable production costs will be £2 million. Which, of course, remember what we looked at when we look at minimum pricing, means that the minimum price they should be selling their toy planes for is £10. So, let's say that a client offers us £14 for every unit we produce. They've offered us £14 for all 200,000. Sounds like a great idea. Our minimum price is £10, and so we should be selling it for anything over £10. But of course, this is where it doesn't work in the long run, because it's not just a case of covering those 2 million in variable costs. We also have to cover the 1 million in rent. We also have to cover the £500,000 in salaries to directors and to managers. So really, our annual expenditure is actually £3.5 million. And to cover that £3.5 million, we'd actually need to sell them at £17.50. The real minimum price when fixed costs are taken into account is £17.50, and this is before even making a profit. So as you can see, it can be quite good for short-term decision making if you just get a small order in for a few that you haven't sold. They've covered the cost that it made the cost to produce them without using up all your fixed cost resources, such as rent and directors, whose salaries and the cost for would be paid for already. But in the long run, you cannot plan for the future using relevant costs and minimum prices, because eventually your fixed costs will need to be paid for. So now finally we're going to look at intangible and non-financial factors. Now, of course, as I mentioned earlier, these are the sorts of things that are going to become more and more prevalent as you continue through your CIMA studies, particularly once you get to strategic level. I'm sure many of you already realise that running a business is not just about the finances. It's not just about the bottom line. There are other things that impact your strategy. There are other things that you must consider. So let's take a look at the other sorts of things that could impact our decision making. So we have to think about employees. Now, if we get an order for more units than we usually produce, then the company might think that's a great thing. That's a great thing that we should do. We will already be covering our costs, and now we're making additional money on top of that. But how are your employees going to react to that? Are they going to be happy that they have to work extra hard for the same pay? Are they going to be happy that you are bringing in new projects, bringing in new products, changing processes? They might fear for their jobs, etc. You have to be mindful of how your employees are going to react to any decision you might make. Competitors as well. How are your competitors going to react if you change your approach? Are they going to copy your approach? If you change and do something else, and it's actually something that they have more capabilities or more capacity to do themselves, they might change to what you're doing and then do it better, and they may even take more of your market share. And as a result, you will have in a sense given your competitors the incentive to do better than you. Think about the overall strategy of the organization as a whole. Does it tie in with our overall goal, with our overall mission statement? Also have to think about how we go about doing our business as well. If we are a public company with shareholders to appease, with pension funds invested in us, we have to be careful about how much risk that we take for ourselves, or how much risk that we put on ourselves. And therefore we might not be able to leverage long-term sustainability for short-term profits. And finally, the government as well. The government obviously is the most powerful stakeholder of any organization, and generally, as long as you're paying your taxes and abiding by the law, then they're not really going to be too concerned about what you are doing. But you have to remember that they may do things that do have an impact on you. For example, if you are a company that produces a lot of candy, a lot of soda drinks, etc., of course you'll have seen in the news recently that many developed countries such as the UK, such as the United States, etc., have been bringing in new guidelines, new laws on the amount of sugar in these drinks, the amount of fat in certain, or saturated fats and trans fats in certain foods. You have to be mindful of how they are going to or what the government is going to do, how they might react in the future, and what kinds of plans they might have that are going to have an impact on the way in which you run your business. Of course, that's just a snapshot of intangible and non-financial factors. There are many other things that might affect it, and many other things relevant to each of those four that I did mention. But that's a good starting point, and should be getting you in the mindset of thinking about other stakeholders. Everything you suggest, even if it's going to make money, think about how it will affect other stakeholders. So that brings us to the end of this first video. I hope you've enjoyed that. In this video, we've looked at some very basic concepts that we're going to build on throughout this series, and hopefully it's given you an insight into the kind of decisions that companies do make on a day-to-day basis, the kinds of things that they have to make, and the information that they use to make those decisions. So once again, thank you very much for watching. I'd just like to take a moment of your time to talk you through the other products that we produce here at Astranti, all designed to help you pass your objective tests exam. So we have our study text, which is a very comprehensive study text that covers every single part of the CIMA syllabus for the specific exam in a very broken down and detailed fashion, and that is available for free on our website. We also have our revision notes, which is for use if you are already somewhat knowledgeable about a particular exam, or if you need a top-up, or if you want to do some really intense revision just before the actual exam. That narrows it down to the very key topics, to the very important bits of information. We also have tuition videos, the entire set of videos similar to the one that you have just watched. So we have one for every single chapter within each exam, and that looks at the chapter in a much more holistic way using various different examples. We then have our exam practice kit, which is 30 questions for every single chapter, and we have 20 easy questions, comprehension questions, designed to test that you have read and that you have digested the information, and then 10 exam style questions for each individual chapter to really test your knowledge, to test that you can actually apply the knowledge. And finally, we have 5 mock exams for every single exam, or for every single subject. And these mock exams are designed to be sat in test conditions on a system similar to the one that you will actually be sitting in the exam. And these products are all available individually, or they are available as one course. So a very comprehensive approach to passing your exam. And if you want to know more, and if you want to see more samples, we have more samples than this YouTube one available on the website. So please visit that, give it a look, and see if you think it will be useful for helping you pass your exam. So please go to the website. It's www.astranti.com. And once again, thank you very much for watching this sample video.